Let's take a look at some foreign exchange rate operations and practice this a bit. So in this table here, we have various foreign currencies, and they're denominated in dollars per unit of foreign currencies. For example, in July 2024, it was $1.29 to get 1 pound sterling. But 10 years prior, in July 2014, it was $1.71 to get 1 pound sterling, so on and so forth. First question says, from 2014 to 2024, which currencies appreciated against the US dollar? Which depreciated? Well, if we look at the pound sterling, over this 10-year period, it looks like the pound sterling got cheaper for Americans with dollars. It took $1.71 to get 1 pound in 2014. 10 years later, in 2024, it took $1.29. If something gets cheaper, then that means that the currency is appreciating. Pounds got cheaper for Americans, so the US dollar appreciated. So I'm going to put the pound sterling depreciated, okay? And then that means dollars appreciated. And you can also think about this in terms of other goods. For example, let's say your house goes down in value. The price that your house would sell for drops. Well, we would say that your house is depreciating in value. Just as pound sterlings went down in value, they depreciated. A house goes down in value, it depreciates. For the Canadian dollar, it looks like it was 93 cents in 2014. It went down to 73 cents. Same pattern. If the Canadian dollar is becoming cheaper for Americans with US dollars, then it's depreciating. The US dollar is appreciating. The euro. The euro was $1.36 in 2014. It went down to $1.09. The euro is going down in price. It's depreciating. The US dollar is appreciating. The yen, same pattern, went from 0.0098, which is just under a penny, to 0.0062, which is a little over half a penny. So that's a depreciation of the yen, and therefore an appreciation of the US dollar. The peso went from about 7 cents in July 2014 to about 5 cents in July 2024. The peso is depreciating. The dollar is therefore appreciating. And then finally, the Turkish lira. The Turkish lira is the most dramatic of these examples. It took 48 cents in US dollar terms to get 1 Turkish lira in 2014. By 2024, it only took 3 cents. Significant drop. So the Turkish lira depreciated and the dollar appreciated. Let's do the second one. It says, in July 2024, if you wanted to buy a new outfit in Paris that costs 143.28 euros, how many US dollars would you need? So let's write down 143.28, because these are euros that we need to buy. And we can look at the price. In July 2024, euros were selling for $1.09. So just like anything else, if you want this many units of something, you just multiply those units by the price, which is 1.09. Okay? And if you do that, you use your calculator here, we can take 143.28 and multiply that by 1.09 per euro, and you get 156.17. Sometimes it helps to just put these currencies in some form that you're used to buying. If I were going to buy 143.28 chocolate candy bars, and the chocolate candy bars cost $1.09 each, then I'm going to have to spend $156.17 to get those candy bars. We're not buying candy bars. We're buying euros. But it's just units of something. And I also recommend work these backwards. Say to yourself, 143.28 euros, units of euros, at $1.09 each equals this amount. But what if I have this amount? Well, if I take that and divide it by $1.09, that will give me 143.28. If I have $156.17, and I divide that by 1.09, this goes away, I'm going to end up with 143.28 euros. So by working it both ways, you can get a better sense of what's happening and also confirm your math. The next one says, in July 2014, if you had $100 and went to exchange them for Japanese yen, how many yen would you receive? Well, again, we write down what we have. We have $100. But in this case, we're using that $100 to buy yen. So we go to yen, and it says, look at the 2014 number. Yen is 0.0098, just under a penny per yen. So what do? Well, if I had $100 and I wanted to buy something that costs just under a penny, I would take that $100 and divide it by that. So 0.098. And if you do that, take 100 divided by 0.0098, 10,204. And that's yen. Okay, let's move on to the next one. It says, in July 2024, how many euros would 1 pound trade for? This table here tells us how each of these currencies trades in dollars, but it doesn't tell us how they trade for each other. But we can easily derive that. And the best way to do this is to think again about a traveling scenario. If we want to know how many euros 1 pound would trade for, let's start out with 1 pound. I'm just going to put here pound, and there's 1 pound. So if you have 1 pound, well, the first thing you're going to do is you're going to take that pound and you're going to go to the market for dollars. Put a little arrow here, and let's trade it for dollars. Well, on this day, it's $1.29 per pound. So if you trade that pound for dollars, you're going to have $1.29. Okay. Now you've got your dollars. Now let's take those dollars to the market for euros, and let's trade them. $1.29 divided by the price of euros, which is 1.09, equals, let's use our calculator here, 129 divided by 1.09, looks like it's 1.18. In other words, if we have 1 pound, we can convert that pound into $1.29. We can then convert that $1.29 into euros, they cost $1.09 each, into 1.18 euros. Therefore, 1 pound trades for 1.18 euros. Again, this is the traveling scenario. I'm in London, I've got a pound, and for one reason or another, I can't trade them directly for euros. It's not going to happen. There's a market that you can directly trade, but just imagine. So I find somebody that will take that pound and give me $1.29 for it. And then I take that $1.29 and I find somebody that will sell me a euro for $1.09. And that means I end up with 1.18 euros. In essence, I turned my pounds into euros at a 1 pound to 1.18 euro ratio. Okay. Now let's shift gears and take a look at the reason that these foreign exchange markets exist. You already know that when there's a demand for dollars in the market for dollars, there is a supply of foreign currency in the foreign currency market. Someone in Mexico will demand dollars and supply pesos. Conversely, if there's a supply of dollars in the dollar market, there's a demand for foreign currency in the foreign currency market. Someone in America will supply dollars to the dollar market to demand pesos to travel to Mexico or do business in Mexico. We've got that. But what we didn't talk about is the reasons for demand for dollars and supply of foreign currency. Supply of dollars and demand for foreign currency. And it comes down to really three major reasons. Why is there a demand for dollars in the dollar market and a supply of the foreign currency? Why do Mexicans supply pesos to demand dollars? Well, it's possible that they want to import goods and services from the U.S. If someone in Mexico wants to purchase an Apple iPhone, then that's an import to them. So they would need to supply their pesos to the peso market to demand dollars in the dollar market to import that Apple iPhone. It's also possible that they want to invest in assets in the U.S. Perhaps someone in Mexico wants to purchase U.S. stock or bonds or any other type of asset. Well, that's investing. And they would need to supply their pesos to demand dollars to purchase that stock or that bond in U.S. asset markets. From the U.S. standpoint, this is sometimes called capital inflow. Here, the term capital is defining money. So money would be flowing into the U.S. to purchase U.S. stocks and bonds, among other assets. A third rationale is foreigners want to speculate on the future of the dollar, future value. Foreign exchange markets fluctuate quite a bit, and because they're international, they're the largest markets in the world. So there's a lot of speculation on future values. And imagine that someone in Mexico believes that the value of the dollar is going to go up in the future, appreciate, meaning they believe the peso is going to go down in value. Well, they may want to demand dollars and supply their pesos, essentially get rid of their pesos and convert them into dollars because they believe the dollar is going to go up in value. That would be speculation. In all three instances, whether Mexicans want to import, invest, or speculate, there is a supply of pesos to demand dollars to bring about those transactions. Now, of course, the same three reasons apply to when we supply dollars to demand pesos. Maybe we want to import goods and services produced in Mexico. Maybe we want to buy Mexican stock or Mexican bonds. From our standpoint, that would be capital outflow. Money would be flowing out of the U.S. to purchase foreign assets. Maybe we want to speculate. Maybe we believe the peso is going to appreciate and the dollar is going to depreciate. In that case, we would want to get rid of our dollars, supply them in the dollar market, and demand those pesos because we believe they're going to go up in value. Continuing on, there are factors that can influence the foreign exchange markets. Those factors will shift the demand curve for dollars and